Ever looked at a stock price and just wondered, what's this company actually worth? Beyond the flashing number on the screen. Well, in this explainer, we're going to break down exactly how investors try to answer that very question. You know that stock price you see? That's really just the last price somebody was willing to pay for one share. It's not the whole story. The real question, the one that separates just guessing from actual investing, is this: what is the company's intrinsic value? Figuring that out, well, that's the key to making smart financial decisions. So, where do we even start? Well, you start with the company's report card. Think about it. Before you can even try to predict a company's future, you have to understand its past, and that whole story is told in its financial statements. Now, this financial story really has three main chapters, and each one gives us a totally different piece of the puzzle. We're going to look at the income statement, the balance sheet, and the super important cash flow statement. First up is the income statement. You'll often hear people call it the P&L, for profit and loss. This is the bottom line, plain and simple. It answers a really basic question. Over a certain period, like a quarter or a year, after all the bills were paid, did the company actually make any money? It's the ultimate measure of profitability. Next up, we've got the balance sheet. Now, if the income statement is like a movie of what happened over time, the balance sheet is a single photograph. It's a snapshot on one particular day of everything a company owns. Those are its assets, and everything it owes. Those are its liabilities. The difference between those two? That's the company's net worth, also known as its equity. And our final report, the cash flow statements. Now, this one is absolutely vital because, let's be real, profit on paper is not the same as actual cash in the bank. This report follows the money as it moves in and out of the business. It tells you, is this company a real cash-generating machine? A company can look profitable but still be burning through cash, and this statement tells you that crucial truth. All right, so we've gone through the report card, we understand the past. Now, to value the future, we need to get a grip on what might be the single most important concept in all of finance. It's called the time value of money, or TVM. And the idea is actually really simple. A dollar today is worth more than that same dollar in the future. Why? Couple of reasons. First, you could invest that dollar today and earn a return on it. And second, inflation means that future dollar is just going to buy you less stuff. This idea is basically the engine that drives all financial valuation. And this whole concept gets supercharged by one little thing: compound interest. Instead of just earning a return on your initial investment, you start earning a return on your returns. It creates this incredible snowball effect, and it's the force that allows wealth to grow exponentially over time. Let's just look at how this works. Say you invest $100 and get a 10% return. In year one, you make $10. Now you have 110. But in year two, you earn 10% on that new total, so you make $11. The next year, you're earning interest on $121. See that? The growth itself starts to grow. That's the power of compounding. So we've got the company's report card, and we have finance's golden rule. Now it's time for the final step, putting it all together to actually slap a price tag on a company's future. Here is maybe the most important takeaway of this whole thing. The value of any asset is simply the sum of all the cash it's expected to spit out in the future. But there's one catch. We have to discount that future cash to figure out what it's worth in today's dollars. And that's exactly where the time value of money comes back into play. For something like a bond, it's actually pretty simple. A bond gives you two things: regular interest payments, and then you get your original investment back at the very end. So a bond's price today is just the present value of all those future cash flows, all added together. Preferred stock is often even simpler because it usually pays a fixed dividend that's not expected to grow. So the formula is nice and straightforward. You just take the annual dividend and you divide it by the return an investor demands for taking on that stock's particular risk. But now for common stock. This is where it gets really fun. We have to introduce a crucial new variable, G, for growth. Unlike a bond, investors expect a company and its dividends to grow. And if you just look at the formula, a higher growth rate makes the bottom part of that fraction smaller, which makes the final price go up. This is exactly why a company's growth story is so critical to its stock price. This formula isn't just a bunch of math. It's telling a story. The dividend, D, that's the reality of what the company is paying out right now. The required return, R, that's the price of risk. And the growth rate, G, that is pure expectation. It's the market's collective hope for the future. So at its core, valuation is this incredible blend of reality, risk, and hope. So let's just zoom out for a second and put this all together. What's the big picture here for you as someone thinking about investing? This right here is the ultimate takeaway. The numbers in those financial statements, that's your evidence. The valuation formulas we looked at, those are your tools. But your real job as an investor is to use that evidence and those tools to tell a compelling, believable story about the company's future. So here's your checklist to take with you. Step 1, read the report card. Analyze those financial statements to see how healthy the company is. Step 2, apply the golden rule. Use the time value of money to figure out what future cash is worth today. And step 3, tell the story. You combine all that data and your expectations to build a valuation model and estimate a price. And this leaves us with one final and really important question. The formulas make valuation look like it's a precise science, but because that G for growth is just an estimate about an uncertain future, valuation is always going to be part art. So the real challenge for every single investor is finding that balance between the math and the story. Thanks for watching.